Welcome back to another episode of the podcast. Today we have the Michael Jordan of lending. His name is John Lachance. I actually consider him an integral part of my real estate investing team. I consider him a personal friend just because we've been working together for so long. But yeah, he is the VP of residential lending over at Georgia Banking Company. Like I said, my lender. John, welcome to the podcast.
Yeah, thanks for having me, Sorry, it's good to see you.
Yeah, it's a pleasure. It's a pleasure having you. So my first question, looking at your LinkedIn page, you have pretty much been in lending for over 10 years. How did you get into mortgage lending? Was it by accident, or did you always kind of see yourself as someone in finance growing up?
Sure. Somewhere in finance, probably yes. Got an undergrad in economics. Numbers have always come relatively easy to me. As far as mortgages, no, I don't know too many people who seek mortgages out. There wasn't a family relationship or anything with it. I graduated college from the University of Mississippi with an economics degree. My parents' neighbor was head of HR at a correspondent lender, and basically I needed a job. I started auditing mortgage files for $1,000 a year, but I was out of college, I needed a job, right? So started auditing, and from there have really learned the process from the very back, right? Auditing a closed loan to the very front where I'm at today, kind of a face of an organization out there, sales, getting builders, investors, realtors signed up. But the whole process really has been learn something, make yourself more valuable, move on to the next, try and any piece of advice I'd have for somebody if they're interested in mortgages is learn every piece of the pie, right? Learn what makes the sausage, and that'll make you a much better salesman. But very much an accident, but I'm stuck now. I've tried to get out. I'm stuck.
It's like when people ask me, "Oh, did you grow up wanting to be an accountant?" I don't think anyone grows up wanting to be an accountant. Like it's not like a sexy job. Say
100%.
But I think it's good when you're in finance and you're surrounded by so many like-minded individuals. So, what was kind of the biggest mistake or one big lesson that you learned on your way from audit, from really just being in the back, like the support team, to now being kind of the face, like you said, in sales, shaking hands?
Sure. So, I mean, and I think this is kind of a rule for any role or position that somebody might look into, but I mean, one of the keys to life, whether it's work or relationships, is just clear communication, right? A mistake that I have learned to not do is don't think a problem will fix itself, or you're just going to figure it out and kind of push it to the side and be like, we're going to figure this out, and not tell the borrower. Right. So I've only done it once, and just learn from your mistakes, y'all, but it's pre-approving somebody and not knowing that they can 100% get to the closing table. That was years ago, and you'll only do it once if you're a good loan officer. I mean, there's mortgages, the regulations change every day, and there's 100 different loan programs. There's conventional GSEs, government subsidized entities, Fannie Mae, Freddie Mac, FHA, HUD-backed loans, VA, USDA, portfolio lending. So it's really just taking your time to go through the process, reading the guidelines, knowing where to look before saying, yes, you can go buy this house, right? So the mistake I've learned is maybe moving too quick. I am purposefully slow and diligent on the front end now, because when I hand you this paper saying you can go buy a house, you can go buy the house, right? So I think in a kind of give me an answer now world that we live in, and instant gratification, and I make $80,000, why can't you just give me a piece of paper?
Yeah.
It's heavily regulated, heavily compliance oriented. Half the cost of a loan is because of compliance. So it's slowing down, taking the time, reading through the guidelines, and making sure you cross your T's, dot your I's, right? So slowing down, setting people up for success, and not just being super quick has been a pretty integral part in kind of how I've shifted just my workflow.
I think there's two parts to that. So one, first and foremost, communication. Even if you make a mistake, or even if something's not going the way that you believe it's going, like if you communicate that, 99% of people are more than understanding versus leaving them in the dark. And then number two, patience. Patience is key. Don't just say something always. And I feel like early on in my career, I used to always want to give an answer up front, but it's so much smarter to just be like, hey, let me think this through, or maybe let me talk to my teammates, and let's see what we can do about this. So I'm sure you've, learn that exact same thing in your career.
Sure. Yeah, and just on the communication aspect, right? Like, it is always much worse in your head than just go ahead and telling the person as it is, because it's fixable most of the time. But it's always worse to just sit on it and then like the person's going to be understanding, right? I mean, some people are a jerk.
Yeah.
If you're a normal human with a little bit of empathy, you'll react well and appreciate that someone's being honest.
Yeah, no, that's awesome. And like you said, going from kind of the back office audit, which I think auditing is like watching paint dry, so kudos to you for doing that. Going from that to now being the VP of residential lending at your bank, what is your day to day actually involved now, and how has it changed throughout the years?
Sure. So I'll just start with what it used to be. It was going to a cubicle, reviewing loan files, making sure the numbers add up. Is it down to the penny? Did we overcharge here? Do we owe somebody a check? Is this loan going to be saleable? Which majority of loans are sold to a bigger bank or turned into a mortgage-backed security with those big GSEs I'm talking about. So that was very much cubicle, 9 to 5, back office. Underwriting allowed me to learn the process, what's an approval, etc. And then I moved to a loan officer assistant, where you're very much a punching bag, if you will, right? Like you have the borrower, the attorney, the real estate agent, the homeowner's insurance, all asking for updates, and it helps keep you on your toes and really learn that customer focused aspect. And then from there, you go into origination, which is VP of residential lending is a fancy title for origination, right? And it's fun to say VP at a bank, right? What I'll say is now it's very much, I have freedom. I'm not tied to a cubicle. I have a 3-year-old and a 1-year-old, so I'm in charge of pickup and drop off and getting them to nannies or grandparents. But right now it's customer faces, customer acquisition, and really just getting people to want to work with us, right? So we're a very local community bank around Atlanta, $2.5 billion right now. So Chase is probably at $1 trillion, if I had to guess. So we're tiny, right? But now it's just customer acquisition, talking about loan programs, and saying, hey, if you need a mortgage, you want it done properly, you want a competitive rate, and trust and transparency throughout the process, use us. So now it's builder meetings, realtor meetings. I can work at 5 a.m. I can work at 10 p.m. because most people getting a loan are working, right? So you shouldn't just have banker hours. So there's a lot of flexibility, but you're almost always kind of working too, because I always give out my cell phone. But what I will say is, going from cubicle to this, it's just a different level of stress, right? It's you're always working, but I do enjoy the ability to sneak out at 3 p.m. or 2 p.m. and go hit a bag of golf balls, or like paid time off is not really a thing anymore. So if you do want freedom in your job, like mortgage sales isn't a bad place to be, just know you're going to be working weekends and nights. So I've done the cubicle, I've done the don't clock in stuff, and there's pros and cons to both.
Back when I used to work for someone else, it was definitely the first one, and now it's more the second one. Now it's more shaking hands, giving my number out, obviously, and then just if I do need a break throughout the day, it's much better to just go ahead and go to a coffee shop instead of be stuck in a cubicle. So I can definitely resonate with you over there.
Sure.
But I actually love the grit. Like every time I need to reach out to you, I don't even expect a response for like a couple hours, and I get a response in 5 minutes. So that always helps out a lot. But just going down that path, how important is it for a real estate investor to build a good team around them, whether it's with their lender, with their CPA, with a good realtor? How integral is that? How have you seen that manifest in your career?
It's good to have people around you that you trust, right? To help you, right? So a lender, you're just looking for a competitive rate, right? Like if you're looking for the absolute lowest rate at all times, someone will eventually get you there, but do they do the job they're supposed to do? Do they communicate clearly, etc.? And mortgage shopping is kind of, getting a mortgage is like getting a loaf of bread, right? You can go anywhere. Like, are you getting your loaf of bread at Dollar General, or people like Publix every now and then, stuff like that, right? So it's knowing somebody who's transparent, honest, they tell you a rate and they don't put a $10,000 charge on it, but you just want availability there. CPA, really, it's going to be kind of that tax strategy for a real estate investor. And you want somebody who maybe has dabbled in it themselves. But just, again, it's somebody who can provide clear guidance on how to best structure that tax strategy. I would focus heavily on somebody who kind of lives close to the neighborhood, right? Like, yes, your realtor would probably want you to do work with them for all over, but there's different licenses involved. But anybody who's kind of really knows that neighborhood well, and you can kind of trust their judgment. And then insurance agent, important as well. It's kind of the same thing as mortgage, right? You can get it anywhere. So I would go back to more that relationship driven. Is it somebody I can get along with? I trust. I know they're giving me a fair shake.
Yeah.
But yeah, I think the CPA advantage is really just the tax advantage and how we're going to maximize our either our write-offs or how do we show the income needed to get the next property, right? Because it's a catch-22 on how you're gonna do it. So a CPA is huge.
Yeah, no, I have this one client right now who's she's trying to buy a home and she wants a refund at the same time and she's a small business owner. So
There you
it's always
go. There you
yeah, it's always fun explaining that like, hey, like you either want to qualify for a house, so you have to show income, or like you don't want your tax bill to be as high, or maybe you want a refund. So you unfortunately can't have both. Do you like working more with investors or more with people who are buying, whether it's for their first time or trading up their personal home? Like, how do you kind of look at that?
I like working with anybody, right? Like I need business. I'll talk to anybody. It's completely different, right? So majority of my business has been that first time home buyer, but that's just the nature of when I started originating, right? I started originating in 2020, end of 22. That's right when interest rates went from 3% to 7%. So any kind of investor, second home, stuff like that dried up pretty quickly, but it's still the people who have life circumstances, need to move. I'm graduating college, I'm having a kid. I want to get into a home. That's just been more of the market that's been out there. Investors have slowed down a little bit with just the way the rates went up, but because of that, there's actually been some kind of adaptation in what's called non-QM or qualified mortgage. Qualified mortgage is something that's just a conventional cookie cutter loan. There's been a kind of an adaptation in loan programs to non-QM, which are investor focused. I've worked with both. I think they're looking for different things, right? Investors looking for cash flow, and first time home buyers really just tell me the monthly payment, but kind of that security, right? So I like both, and it's kind of all I can do for anybody is lay out a couple options and say, this is what I would do in your situation. But no, I appreciate all aspects of the real estate industry, and I'm happy to talk to whoever.
So yeah, going along that line, what are you seeing with rates right now, and how are buyers adjusting? Whether they're hesitating or just kind of switching plans, maybe they're thinking about putting more down than they have on other properties in the past. How are you kind of seeing that in the marketplace right now?
Yeah, so last Friday we were at 3-year lows. If you're a good credit, kind of a prime buyer, you're in the high fives, 5.875, 5.99, etc. FHA, which is a first-time home buyer, and it's not specifically for first-time home buyer, it's mostly used for that, low down payment, low credit. Those were in the mid fives. And then there was an event that happened after markets closed on Friday where we decided to bomb Iran. So rates are up again. They're still in the low sixes, right? Six and an eighth, 6.125 compared to 5 and 7/8. I think the rate itself isn't necessarily the problem. Historically, they're kind of low. It's just the appreciation, the value of a home went up 10, 20, 25% from 19 to 20, 21, 22. It slowed down. The appreciation slowed down. The rate, it's more psychological. People want to see a 5 as opposed to a 6. The difference might be $25 a month depending on your price range. And if you're looking in that jumbo market, $1 million plus, you're probably less worried about the $100 a month you save on the eighth of a rate, right? So rates are volatile would be the word to put it. My strategy is when home shopping, you lock your rate after you're under contract. My strategy is lock the rate. If they fall off a cliff, you can either leave me as a lender to go to somebody offering you a better deal, or because I want your business, I'll just go back to my lock desk secondary team and say, give us meet us in the middle, right? So let's say we're at 6, they fall to 5.5, I'll get you 5.75. But we don't want to lose a deal because of it, but it protects you from that upside pressure. So I always say, hey, if you're comfortable with the payment, lock now. It protects you. If it falls off a cliff, you can either leave me at the altar or I'll go back to bat for you. Volatility is the name of the game. I mean, tariffs on, off, Supreme Court bars them. I'll use this other law to put them back on. So we live in an uncertain environment and unprecedented, right? How many times have we heard that word since 2020? So the rate is, I hate saying that, but I recommend locking. We can go through the different options, discuss all that, but it's volatile. And I don't think I'll end that question on this. If you're sitting on the sideline waiting for a lower rate, I don't see them going much lower than this 5.5, 6 range, just because inflation is persistent. And if you are an investor, you require a rate of return that is going to protect you against your asset being depleted by inflation, right? So if inflation is consistently 2.5%, you need that return. And a good barometer measure is the 10-year treasury of the US bond. So just keep an eye on that. Add 2%, you're roughly where you are mortgage wise. But again, rates, no one knows.
Yeah.
I just said I'll end it. The last thing I'll say is, if somebody tells you which way the rates are going, don't listen to them. They're going to go up, down, stay the same. Nobody knows.
Yeah, I mean, for anyone listening, he just dropped a master class. So if anyone needs a good lender, once again, John's the man. First and foremost, it seems like they purposely start these wars on the weekend
100.
when
I
mean
think so.
the market's closed. So
Right.
that always sucks, but I think another good thing that you just mentioned is communication. So if someone just psychologically wants to see it in the fives versus the sixes, if you break it down for them and just say, hey, you're saving an extra 20 or 30 bucks, most rational people will be like, oh, okay, so I'm not going to make that big of a that much of a fuss about this. So I think that's good. And then yeah, like people who are waiting for the rate to keep dropping. I think so many investors or even first-time home buyers got spoiled with 20 and they're just waiting and waiting and waiting, and that's most likely not going to happen for a long time. Like just this morning I was speaking with one of my clients and he's like, oh, I think I might wait 2 years to buy a home when rates drop. I'm like, rates aren't going to drop in 2 years unless, and then once again, I don't know, you don't know, no one knows. So if anyone's trying to, they're like, what is this arbitrary 2 year timeline you're waiting on? So yeah, any thoughts on that, guy?
Yeah. So I like to attend kind of research sessions or kind of keynote speakers about the housing market. The latest one I went to was last Wednesday, and they were projecting rates to actually go up over the next 2 years. And again, it's just kind of right now we're at 6. They were saying we're going to be in this high 5, 6, then probably trend up towards like 6.5. And again, it's coming down to inflation, devaluation of the dollar, and needing a return, right? So you're paying a bank, but somebody owns that mortgage, right? And they are going to, if they can't get a return on it, they'll just go put their money in a U.S. bond, right? Something safer, right? So because a mortgage is technically a little riskier, it's because people foreclose, right? Default on loans all the time. They require a little bit bigger of a spread, right? So again, you need to be comfortable with the payment, right? That's first things first. You don't want to be house poor. But if you're just trying to time the market, it's the old saying, time in market beats timing the market, right? So houses are going to appreciate, right? At least we hope. Because it's not '08 where people were doing no doc loans or owning 17 properties, right? Underwriting is a lot stricter. People have a ton of equity in their homes. So I don't see it falling off a cliff. If you're waiting, what I would do is I'd have a conversation with a lender, reach out, see what your options are. Can I get into this house? It is very much a buyer's market right now, where the buyer can make the seller pay closing costs, which is a kind of a hidden cost people don't think about. So, I mean, if you're waiting, but you want to own a home, there's no point in sitting around. Go figure out what you can qualify for, see if it makes sense, and then make your decision.
Yeah, I saw this crazy stat the other day where I think there's 600,000 more buyers than sellers, right? Or sellers than buyers right now. So yeah, if you're listening to this, whether you're trying to get into your first property, whether you're trying to get out of your first home and get your first rental property, definitely talk to a lender. Obviously, my personal preference is John. Talk to a lender, see what you can qualify for, see what makes sense. And like he said, time in market always beats timing the market. If you keep saying you're going to wait 2 years for this or 3 years for that, which, at the end of the day, it's all just arbitrary. So go ahead and have that conversation now. The thing is, working with a professional like John, you don't know what you don't know. So someone like him or even someone like myself, I can break down the tax side of it, and you might get a nugget of information that you didn't know you needed to know, and it might change how you think about things. But yeah, moving into more boring tax and bookkeeping questions, because this is a tax podcast at the end of the day. I know you have valuable experience working with the underwriting team. So what do underwriters actually look at? What are some red or green flags when you're trying to qualify for a home?
Yeah, sure. So, I mean, simply put, it's not just your revenue, right? Like I've had people that show $1 million in revenue, but then write everything off, and then their net proceeds are 12 grand a year, right? We're going to start at your net, what you're netting, right? And so that's after COGS and any kind of write-off and stuff like that. So start with line 32. I want to say you're the CPA, but start with line 32 of your tax returns, divide that by 12. That's your monthly income. If you don't show the income to the IRS, right, then we're not going to give you credit for it, right? There are some items we're able to add back in, such as amortization or depreciation. That would be kind of your harder assets, right? But what I'll say is you got to show the income on paper. Yes, you're taking the tax hit. Now, I mentioned a little bit about non-QM loans earlier. There's something out there if you're an investor, not a primary, this isn't your primary home, where we can just skip looking at tax returns. We just look at does the property cash flow. So we're looking at the appraisal, comparable rents versus the payment. If it's 1-to-1, you're fine. But as far as just when you're filing your taxes, talk to your CPA, right? He knows the Schedule C versus S Corp a little better than me. But it's going to be what you show on paper that you make. What are you reporting to the IRS? That's your starting point.
That was good. And that was actually going to be my next question. Thank you for taking us there. I was going to ask, how do you look at income when it's someone on Schedule C versus someone who has their S Corp and they're paying themselves wages? So technically they have a W-2, but that W-2 is coming from their own business. How does that kind of affect what you can qualify them for?
Yeah, absolutely. And I think this is a pretty common mistake that I've seen lenders make. Not going to name names, but somebody said they couldn't do a loan somewhere and it ended up being passed my way and we did the loan. So Schedule C, right? Sole proprietorship, we're just looking at what is the income show on that Schedule C, right? It's pretty straightforward. You're self-employed 100%. S Corp, we can use those W-2 wages, right? We are also going to look at, of course, what the business is doing in cash flow and K1 distributions and stuff like that and percentage of ownership. But if you are paying yourself $1,000 a year W-2 and you didn't just start doing it yesterday, it's on your tax returns, you have the W-2s, we can use that income, right? So if your business is running at a loss, we're going to have to count that against you. But if your business K1 distribution is $1,000 with 50% ownership, then we'll give you what's credit for that? $5,000 a month, right? $2,500 because we divide it by 2. But if you're giving yourself a W-2, we can use that. So a pretty common mistake and very valuable to underwriting to have that W-2 income on your S Corp.
Yeah, and where I wanted to go with that was, obviously we're not going to get through a whole masterclass of investing and lending and tax returns in a 30-minute podcast. But hopefully, if anyone's listening to this and you at this point, you should realize that just because you're a business owner doesn't mean you have to write everything off, or just because you're a business owner doesn't mean it doesn't necessarily mean it's harder to get approved for something. So just once again, reach out and have those conversations early. And you should always try to plan for the future instead of trying to be a historian and look back at the past and see what's happened. There's no reason you can't talk to one of us and then we can lead you down a direction like, hey, you might lose a little bit of money on the business for the K1, but you need to pay yourself a W-2 so that you can approve for your first home or something like that.
100%.
Yeah. But okay. Last little segment before we leave, I'm going to ask you some rapid fire questions if you're down for that. So
let's see.
So my first one is, what do you value more? What do you see investors or even homeowners value, or not homeowners? What do you see investors value more? What do you value more, cash flow or appreciation?
Can I say balanced? I mean, it's got a cash flow to make sense, right? Hoping for appreciation is hoping, right? So personally, I would say cash flow, but in an ideal world, you have a little bit of both.
Yeah, I was actually speaking with another investor, and he has both. One of my properties, I have neither one, so I'm just looking at him from the sideline, super jealous. But what do you think is the biggest mistake that investors make?
The urge to act quickly, right? So, what I would say is kind of where you see this neighborhood property in a year, right? So it's hard to project, right? But you can look at where are people moving is a huge thing, right? And it's just kind of, and again, it goes back to the same thing with approval. Just slow down, have kind of a vision for the next 12 to 18 months.
What is the best financial advice you've ever received?
It's kind of financial advice, but it's just make as much money as you can and give as much as you can, right? So it's kind of a balance of, yes, you work, but you want to be a steward of kind of good faith too, right? So, I mean, live below your means is the simplest advice. But if you have a job where you can go after it and self-employed, right? Go out there, go after it, get it. And then kind of once you've taken care of yourself and your family, give back.
Yeah, you hear a lot of successful people say that actually. All right, last question. What is one habit that has contributed most to your success and your meteoric rise in lending?
So, I mean, it's not really a habit, but communicate clearly, be personable, like just get along with your coworkers. Don't burn bridges. Don't do that. But a habit that's kind of helped me just settle in and get ready is waking up early. Like if I gotta have that. Like I said, I have a 3-year-old and a 1-year-old, and the day is emails and calls and podcasts. So just waking up early, taking that moment to just have some silence. Give it a try if you like to sleep in.
Yeah,